A big welcome to all our readers and subscribers, and thank you for joining us today for our panel discussion on what the future holds for UK investors or equities. My name's Julian Hoffman, and I'm Deputy Companies Head Editor here at the Investors Chronicle. Having spent much of my career here, I fall very much into the magazine's veterans category and tend to write mainly on the value of investing and deep accounts analysis. So today we're going to be looking at the future for UK equities. And before we conclude that this is grim, allow me first to introduce each of our guests in turn. Our first guest today is Simon Gurgle. He's Chief Investment Officer, UK Equities for Merchant Trust, and also runs the Allianz UK Listed Equity Fund. And so naturally has a strong interest in value and income investing. Isn't that right, Simon?
That's absolutely right, yes.
Yeah, thank you very much for joining us today.
Sorry.
Our next guest is Jochen Clement. He's head of strategy at Liberum Capital and has a focus on European equities. He's held senior research positions at Credit Suisse and UBS management. Thank you for joining us today. I was teasing you earlier that about your settled status, but we're assured that you're here on an entirely legal basis.
No, entirely. At least this German isn't going anywhere soon.
Thank you very much. Our final but by no means least guest is Eloise Graef. I hope I pronounced that correctly. She's a research fellow in machine learning at the University of Oxford, board member of an Australian biometric startup, and is an Oxford Enterprise and Innovation Fellow. In her spare time, she's also an elite pro popular investor on eToro and has a focus on long-term investment strategies. Thank you, Helen. I don't know how you found the time, but you pack a lot in there. Does that help in your investing life?
Oh, definitely helps being able to juggle the complexities of investing.
You can imagine, and maybe you'll find an algorithm that can replace the moderator in a few years' time. But we might get to that point. That's right. Anyway, so the question for the panel is pretty straightforward, but we need to start off with learning where we're going by where we've come from. So I just wondered, Simon, if I could start with you. What have been the key lessons and trends that you feel have emerged from the last couple of years, and where are we going with this?
Yeah, I mean, it's been a fascinating period. I think one thing we've learned in the last couple of years is that there's always uncertainty in the world, and that we should be prepared for the unexpected. I mean, we couldn't have seen the pandemic coming. We may not have seen the invasion of Ukraine by Russia. I think what else have we learned? We've learned that valuation ultimately matters, that money is not free forever. That lesson has become quite clear, certainly this year, if not halfway through last year. And I think as investors, we've probably learned that I think the best way to navigate is probably to keep a focus on the long-term horizon, long-term future, and not to get too carried away in some of the short-term volatility and noise. And there are always opportunities for investors, but there are always risks as well. So I think it's been a fascinating period. I think I'm sure we're going to come on to discuss where we go, but I think we learned just to expect the unexpected and therefore to prepare your portfolio the way you think about life for different scenarios. That you can't know what the central scenario is going to be, or you can have a central scenario, but you wouldn't necessarily ascribe a very high probability to that.
Okay, that's an interesting point. I mean, how about you, Joachim? What's your take on that?
Yeah, I think the ability to look past the next couple of months is a key wisdom that we should have learned from the last couple of years, especially when I look back into the pandemic period. We were all kind of very much like deers in the headlights, trying to figure out what to do with the pandemic and how to react to it. And it turns out that equity markets are, in the long run, quite a bit more resilient than many people think. So even if in the short run we see a lot of panicking around us, and as I say this, we do see a lot of panic around us over the last couple of weeks again. I think that the key lesson is that if you are a long-term investor, you should be able to look beyond these things and use them actually as opportunities for long-term investment success.
Okay, perfect. And Eloise, let's bring you in on that. What's your take on the last couple of years and the lessons that you want to draw from it?
Yeah, I mean, I can only echo the sentiments of Simon and Joachim, where it's become so important for us to not let our emotions flow through into the stock market. And this period has just again highlighted the difficulty of making investment decisions based on predictions of where the markets will go, as well as enduring the benefits of diversification and flexibility in your portfolio strategy. And as Simon was saying, being, able to adjust that. But something I'm personally quite excited about, which has come about in the last 2 years, has been this new generation of retail investors who, through their coordinated or uncoordinated efforts, have been able to influence the market, as we've seen that additional capital that's previously been untapped being pushed into the capital markets. And then again, if we talk about the decision-making process, I think the internet really connects retail investors across the board to empower them. But yeah, that does make it quite tricky to make these decisions and predictions.
Okay, thank you very much. So, I mean, let's just open it out a bit. What were the features, if I put this question to the panel generally, I mean, what were the UK market's key strengths, weaknesses, and how do you think that will play out, or how will that take the market forward? Let me just open it up. Who would like to speak? Who would like to tackle that first?
I'm happy to have a go. I think.
Go ahead, Simon. Yeah.
I think one of the a couple of features. One of the things about the UK market, it's very international. So the UK market, 60 to 70% of the sales and profits come from abroad, actually from the UK. The UK has a history as a very trading nation, and therefore you can invest in the UK and get exposure to the globe, to global industries. But we also have some of the highest standards of corporate governance. We at Allianz Global Investors, we vote across the world on proxy voting on shareholder resolutions, and the UK is the area where we have the fewest votes where we cast against management or against the companies, which is a standard of how high the standards of governance and stewardship are in the UK. So I think it's a great combination. On top of that, the valuations of the UK market are very low compared to other markets, even if you adjust for the sector differences. So I think that is a good combination to start with if you're looking at somewhere potentially to invest. And we are starting to see a bit more interest in the UK. I think there's been a lot of political uncertainty in the UK in the last few years because of Brexit. That is now starting to subside. And actually, although there's current uncertainty about the Prime Minister and the government, I think the difference in policy between the left and the right, between Conservatives and Labour in the UK is actually pretty minimal at the moment, or certainly a lot less than it was 2 or 3 years ago. So the political risk in the UK feels lower than it has been as well. So that's where I'd start.
Okay, perfect. And Eloise, I mean, we talked a little bit in the green room about the perspective on the tech bubble. What would your take on that be?
Yeah, the UK market is not necessarily known for its technology companies. It's more well known for its exposure to commodities and the financial services. Together, those account for something like 45% of the market in the UK, and those are really down to the giants like HSBC, Shell, Rio Tinto, some of the largest companies in their fields globally. And so subsequently, the FTSE 100 has a very low exposure to the technology sector, and that's certainly been a drag for UK investors during the recent tech bubble period, when the markets were really more focused on fast-growing businesses. But that certainly means that the UK market may have missed out on some of the really good investment opportunities during this period, while the global sentiment was geared towards higher risk. But that hasn't necessarily been a bad thing, because it also means that the UK exposure would have shielded investors from the drastic rotation away from growth stocks that we've seen starting at the end of last year. And so investors with a really heavy UK exposure, depending on their risk appetite, may actually be quite relieved that they missed out on that tech bubble, because they also missed out on the bursting of it.
Well, there is a value, isn't there, to pedestrian mediocrity, isn't there? They don't tend to lose money over a short period of time. Joachim, you'll have a sort of broader perspective on equity strategy. What does it mean for investors when you have an index that has lots of these mature companies? How would you approach it from an equity strategy point of view?
Well, so I mean, there's nothing wrong with getting rich slowly, I would say. And I think especially this year, we learn the benefits of these slow compounders, or rather stable compounders, I would say. And you know, the UK equity market, especially if you go into the large cap space of the FTSE 100, is not the most dynamic. It is not the one that goes up the most when tech stocks are flying, but it is also not the market that is going down the most when we're in a recession, which basically is what Simon alluded to. We've got companies that are essentially global companies, and in particular companies that earn a lot of their revenues in US dollars, whether that's coming from commodities or whether it's in the financial space. And the good thing about all of this is, even though I dread going on vacation in summer with the weak sterling at the moment, the good news is that these global earners and these dollar earners have an inherent buffer in their top line revenues from a strengthening dollar whenever the markets are getting a bit upset about declining economic growth, for example, and fleeing into the US dollar.
Okay, so there is the dollar angle, isn't it, to take into consideration? I mean, Simon, how does that affect your view when you're looking at companies? Do you look for dollar earnings as a major part of your strategy?
We don't specifically do that. We tell because the I mean it is part of the nature of business. I think what we're doing at the moment though is we are looking at the US economy, and companies with exposure to the US economy itself feels like it may be a slightly safer place to be than much of Europe, because the US is more self-sufficient in energy, and so that could be quite a big driver of economic growth for the next few years, or should be less risk, I suppose, is another way of putting it. Therefore, if we can find good businesses exposed to the US economy, then that's quite attractive. But US dollar per se could be a global energy company, a global mining company. Doesn't necessarily mean you've got US economic relationship. So there are two different things, and we don't seek out dollars particularly, but we are quite interested in US earnings.
Okay, excellent. And just to bring out the contrast, Joachim, you have to come back to you for a second. You have this specialization in European equities. I wonder, can you just bring out for our audience what the difference is between that and the market, and does something highlight the strengths that you have in the UK when compared with what you see on the continent, for example?
I think at the moment there are two key differences between the European, and with that I mostly mean the Eurozone equity market and the UK equity market. On the one hand, it is the fact that when it comes to international trade, especially Germany and France are far more dependent on exports to China, whether it is in luxury goods or in cars and the machinery and equipment area, than the UK is in that respect. And with Chinese growth slowing down, that makes at the moment for a better outlook for UK markets overall. I think the more important thing is also that we are still living in a world with significant geopolitical risks. I mean, the Russia-Ukraine sword of Damocles is hovering above us. And while now during the summer months, our dependency on Russian natural gas has declined in general, come winter, the Eurozone, and in particular countries like Poland and Germany, cannot make it through the winter without natural gas from Russia. In comparison, the UK is basically sustaining in terms of its natural gas and oil supply, and that insulates it from any kind of moves that the Russian government might make to curb gas exports to Europe.
Excellent. Well, thank you for that. We just have to hope in the UK that Scotland doesn't become independent. In that case, that might be the thing that throws things off course. Eloise, just to bring you in, I mean, you're looking at things in a very broad perspective in terms of your strategies. Is there an argument for diversification or for specialization in one market? And would the UK market be one area that would be worth concentrating on everything in?
I mean, if we're talking about a well-diversified portfolio, having exposure to a single market certainly, yeah, would be quite risky. But over the last year, we've definitely shifted our portfolio away from being a purely US based portfolio to including more UK and Europe stocks, just to make sure that, it's really a bet about which horse is going to be out of the recovery soonest, whether it's going to be Europe or UK or US going forward. And so just kind of hedging your bets on different horses does reduce your exposure in the long term.
Okay, excellent. And just moving on really to, I think, a broader point that we all have to grapple with at the moment. I mean, and that's going to be how inflation impacts people's investment decisions. I mean, I'll open this up to anyone who wants to answer, but I mean, if inflation is now the overriding concern for most investors, is there a response that they can make to it? Does it really matter? And what sort of quirks does it throw up in terms of the companies you look at? I'll open it up to anyone who wants to answer that.
Maybe I'll go first. I mean, clearly inflation matters. The cost of living crisis that we experience in the UK and similarly in the US and in the EU and Europe overall is felt by consumers. Now, on the positive side, there's a lot of excess savings that many households have coming out of the pandemic, and that buffers some of that increased cost for energy and food. But especially when it comes to lower income households, they already have to start cutting back in some of their consumption decisions. And that is certainly going to be a drag on consumption growth going forward, and with that on economic growth. But there are also effects, of course, on the investment side. If you are faced with substantial inflation as a business, well, you have to find ways around that kind of cost pressure. And that's easier for companies that are asset light, and that have certain pricing power or certain ways of generating higher revenues that compensate for the increase in inflation.
Okay, that's an interesting point. I mean, Simon, from a stock picking angle, how would you factor that into your calculations when you're looking at companies? Is there a methodology that you have to change, or are there things that are affected in your decisions?
Well, that last point is very, very key, actually, is pricing power. Can companies pass through pricing to the consumers? And ultimately, most certainly most big British companies have been around a long time. They do have some sort of pricing power, or they wouldn't have survived. But there can be a time lag, so you may see short term some pressure on that earnings, and then they get it through later. There's also other considerations, though. Clearly, as prices go up, it hits the demand. Demand could be offset or upset, because prices are too high, and that could see lower spending on the products. But there's other considerations like assets companies have got. So if you buy a company with assets that might grow over time with inflation, so a house builder has a lot of land typically, it's a property company, they have real assets which go up in value, that gives you some protection against inflation. If you have companies that can raise their prices on some sort of regulatory formula linked to inflation, that can be helpful for some of the utilities. So you have to look almost company by company, but certainly industry by industry, at the different impacts of inflation, and think not just about the immediate impact, but what does ultimately have that do to long-term demand. And then also the biggest risk is probably not inflation itself, but unemployment. And as long as people are still in work and actually wages are growing quite fast, then the economy is probably okay from a nominal point of view. We may have a technical recession from the economy might grow slightly lower than a high rate of inflation. But if people start to lose their jobs and companies cut back significantly, then I think we are in a more difficult scenario, and that's where you would see a bigger impact on end demand, and more uncertainty. So it's there's a lot to that question. There's a lot to think about, but the company level, it's unfortunately it's very detailed analysis you need to do and think about individual businesses and industries.
Because it can affect how you view certain metrics. Because if you're looking at things like return on capital, inflation can completely mess up your view of that. I mean, what sort of pitfalls can people avoid, or what sort of things can you sort of get caught in
Well, historically, yeah. Historically, the equity market tends to like the rate of inflation to between about 2 and 4%. Below 2% is a sign of a really sluggish and low growth economy. Above 4, you start to have the type of problems you talked about, where when you're replacing your equipment and your capital spend, it's costing you more. So the business is absorbing more cash in order to just keep funding itself. If you have inventory, stock, that absorbs more cash as well as you grow, or even if you're even a static business with inflation. So cash generation of companies tends to drop as inflation goes up, which is another reason why you might pay a lower valuation for those earnings, because they are generating less cash. And also the discount rate goes up, so investors demand a higher return when inflation's higher. And again, that pushes you to a lower valuation of shares. So it's there are those two measures, the discount rate and the return on capital, as you talked about. I think that can both be impacted with higher rates of inflation.
Okay. And Eloise, just to turn to you for a minute. What about, you have experience with technology companies which are typically inventory light. I mean, they don't tend to have anything that sits on the books for very long. Is there an impact that inflation has on those kind of companies? And I mean, how would you define that?
Yeah, definitely. They're probably one of the ones that are most hardest hit during inflation. As the purchasing power reduces, we also see an increase in the cost of borrowing, which a lot of the kind of startups and early growth tech companies tend to rely on. But the investors are essentially banking largely on future income streams. So what we have seen with these uncertain times during the current market conditions is that investors typically lean more towards equities that provide near-term earnings certainty, and they've really been shunning these growth-orientated sectors, which technology very clearly falls into.
Oh, that's an interesting point, isn't it? So the rotation into value is something that the UK market has benefited from. Is that a general point that everyone can agree with?
Absolutely. I
Yes.
mean, especially over the last 6 months, we've seen the discount rate effect dominate the valuation development in the markets. And with UK companies on average having, you may call it shorter duration, basically more of their future cash flows nearer to the present day than a growth company in the tech sector, for example, that means that higher discount rates force less of a lower fair value for valuations for companies. And so the UK stock market has been the prime beneficiary of that effect. Where it might get a bit tricky if we look into the second half of this year is what happens if inflation starts to top out and slowly declines, because it is not just the level of inflation, but also the direction of inflation. As inflation starts to drop, investors look forward in their assessments of future cash flows, and that means that a lot of these growth companies might actually get a little bit more support as investors start to price out some of those cost pressures that the companies see at the moment.
Yes. Okay, that's an interesting point. I mean, Simon, from a value investor point of view, the rotation poses problems, doesn't it? Because at what point if everybody's piling into value shares, do they still retain their status as value shares? I mean, does that how do you tackle that from your point of view?
That's a great question. Let me just follow up one thing and then come back to that, if I may. I think one other thing about the UK, it's not just about the duration of companies, it's also the mix of the businesses. So we have a lot of natural resources companies, energy, mining, which have benefited from higher commodity prices, which is fueling the inflation. We have a lot of regulated utilities. So there's quite a few businesses that benefit more directly, not just from the duration of their cash flows, but also from the type of industry they're in. On the value rotation, that's a fascinating question. Of course, the great thing about being a value investor is the universe today is not the same as the universe yesterday or tomorrow. There is natural rotation, and one of the reasons I think value investing can work long term is you are forever buying different types of businesses that when they happen to be attractively priced, you're not always buying the same companies. In fact, we're very careful not to say this is a value sector. Energy is a value sector, because it may or may not be a value sector. It has, for the last few years, it might have been lowly priced, but at some point in the future, it might be highly priced. We're always looking for good companies, fundamentally sound businesses that are attractively priced. And so if you get a big rotation in the market, you can see opportunities to buy as a value investor into areas you couldn't buy before. And also for same with income, if you're looking for a yield, many companies, as they fall back in price, dividend yield rises, brings new companies into our universe that we can buy. So it's quite an exciting time. And our portfolio today is very different to our portfolio 2 years ago, precisely because of that rotation. Whereas I think if you're a growth investor, a pure growth investor, often the portfolio tends to be a lot more stable over time. It's the same type of companies, and depending on your investment process, of course, but they tend not to have the same rotation as value investors might do.
Yes, I mean that's an important point, isn't it? I mean, how about Eloise? I mean, what's your take on that split between growth and value and a kind of the tipping points? Is that something that you take into account, or do you see that a lot in the areas you look at?
Yeah, that's definitely an important point. And although our portfolio was typically a growth invested in growth companies, I think Simon makes an important point about how things changes over time and how we do need to take that into consideration. I mean, another good example is we love to say that the UK is not a tech heavy, market, but at some point the line between tech and other sectors become quite blurred. I'm thinking specifically like fintech. The UK has a really strong fintech sector, and so at what point do you say something is financial versus something is tech? And so yeah, it's really just about staying up to date with how companies and how the economy is changing, really.
Excellent. Very well. Thank you very much.
So
I think what we'll do now is we'll move on to the future predictions that we want to look at. Obviously, this leaves a hostage to fortune because this will be taped and could be played back at you at some point. I have an audience question here, which is, I guess, related in some way to value, but I just wondered if anyone wants to have a go at the outlook for UK dividends over the next 12 months. Are dividends? I mean, I guess you could split that into two. Are dividends really integral to how people invest? And does it really matter in terms of if you're taking a value approach? I don't know. Whoever wants to come in on that would be great. Simon, go.
Start if you like, because I'm a dividend income investor. Our investment trust, the Merchants Trust, has grown its dividend for 40 years, so it's quite an important part of our investment process to focus on dividends. I think, and one of the great things about the UK as well is there is a recognised dividend culture in the UK, where companies understand that if they're not necessarily mature business, but if they're generating sustainable cash beyond what they need in the company, that it's sensible to pay an ongoing dividend. Not the same necessarily in America in particular, and not the same elsewhere around the world, but there is a strong culture of dividends in the UK. In terms of the outlook, we've seen a very rapid recovery. We saw probably certainly the deepest cut to dividend levels across the market in 2020 that I've ever seen, and probably anyone's ever seen, because it was huge cut, but a very rapid recovery as companies have rebuilt their dividend cover, rebuilt their cash flows and their balance sheets. As we look forward, at the moment, we're still seeing pretty good trends on dividends. There are more concerns about the economy, but we're not yet seeing wholesale dividend cuts like we saw in 2020, with the exception of one or two companies which are directly exposed to Russia or the Ukraine or the situation in Ukraine. We haven't seen many dividend cuts, and trading and balance sheets remain good. So we are still seeing a positive view on dividend growth. Something we've got to keep under examination as we go forward, because clearly there are challenges. High inflation is not necessarily bad for nominal dividend growth, but clearly getting a real dividend growth is more of a challenge potentially if inflation is very high. But you might expect to see nominal dividend growth go up in absolute terms as inflation picks up. So the outlook for dividends at the moment, at least, is pretty good in the UK.
Excellent, thank you. So is that something that's mirrored in the European equities, or how do you what's your take on that, Joachim?
One of my favorite charts to look at these days is the development of dividend cover. So how often or how much are expected dividends covered by actual operating earnings? And the good news here is that coming out of the 2020 pandemic, yes, absolutely, it's been the biggest cut in dividends that I and Simon have seen in our lifetime. But the companies that are paying a dividend have much, much higher dividend cover now. So those that are still paying a dividend, those dividends are more than safe, in particular for those sectors and industries like the commodity related sectors where high commodity prices have basically created, I don't want to use the word windfall because that has negative connotations these days, but has created a lot of free cash flow to pay the dividends and to possibly increase them. Or at least increase share buybacks if the companies think that is something that they want to do for going forward. So we see that also in Europe, but it is clearly more pronounced in the UK equity market. So in terms of dividend and income oriented investors, they're definitely better served with the UK market in terms of safety for those income streams.
Is that partly a cultural difference, Joachim? Because obviously, when you look at the German equities, there tends to be these large family holdings, A and B shares. I mean, does that play a role? Do you think in the difference?
There's a lot of there's a lot of philosophical difference. I mean, Eloise has already alluded to, I think, to the US, where dividends are getting more and more abolished in favor of share buybacks. And then it is very much a question of also distinguishing between how the company is run. Is the company run for growth or is the company run for income? And I would say in the UK, a lot of businesses historically, because a lot of retail investors and pension funds alike were relying on these dividend cash flows and dividend flows, the UK businesses have been run much more for income than in Europe, where independent pension funds and private savers have been less important, let's say, compared to the UK. There's still a bit of a distinction. If you look into family-owned and family-run businesses across Europe, they tend to have overall higher dividend yields and stable cash flows because often the owner and his or her family do rely on that income stream to cover living expenses and lifestyle costs.
That is a fascinating point. I wonder, Eloise, I mean, have you come across sort of family companies and things that which you look at from a dividend point of view, or I mean, what's your take on the question we've been debating?
Yeah, I mean, we don't specifically focus on family-run companies for their income, but certainly one of the big strengths or advantages of the UK markets or UK-listed companies has been their strong historical dividend yields. And so when we do decide to give more exposure to the UK market in the portfolio, that's definitely one of the considerations that we can take into account, especially during an increase in inflation period as we're going through.
Okay, excellent. Well, thank you very much. So we've got one more audience question come in. So Henry Nickel writes, what is the maximum interest rate the market anticipates to reprice UK equities? I think I've understood that correctly. So does anyone want to come in on that? That's quite I guess we have to ask the Bank of England, don't we, on that? But are people looking at a maximum interest rate, and how might that affect the performance of UK prices?
I mean,
UK equity.
if I may start, we 3 weeks ago actually looked deeply into this topic of not so much about how much is priced into the market, but how far can the Bank of England go and sustain higher interest rates. And the answer is actually quite depressing. So this is the German coming out here. Given the amount of debt that is in the system, and I'm less concerned here about mortgage debt and household debt, because households have delevered quite a bit since the housing crisis of 2006 to 8, but mostly about corporate debt. And as the Bank of England increases rates, that filters through over time into higher bond yields and higher interest rate costs for corporates if they replace an existing loan with a new loan or an existing bond with a new bond. And that very quickly makes investment growth really hard to attain, because if you increase from 0.5 bank rate to say 2.5 bank rate, and you add maybe a credit spread of 200 basis points, effectively you're doubling the cost of debt for a corporation. and all of a sudden half of your investment growth capital is no longer there because you have to pay it in terms of servicing your debt. And that's what really worrisome. And to cut a long story short, it seems like that even if the bank goes all the way to 2.5–3% bank rate, that is an unsustainably high level of interest rates in the corporate sector, and will inevitably trigger a slowdown in the economy that might end up in a recession and force the bank to cut back down again to 2% and below.
Oh, that's an interesting point. I mean, that sort of puts the private equity interest in UK corporates into some perspective as well, doesn't it? I think you could clearly see. I mean, Eloise, what would you have a view on that? I mean, private equity has been hoovering up British companies. I mean, is that a debt-led? But could they be causing a debt-led problem there?
Yeah, partly. I mean, even though the market hasn't had an appetite for UK companies because they were assumed too difficult, somebody's been buying the UK shares, and that's been the private equity. So, I mean, the valuation discounts are largely, we believe, unwarranted, and so UK-listed companies continue to be picked off by overseas private equity buyers, and overseas industry peers are really taking advantage of the lower valuation, particularly in the wave of mergers and acquisitions. So,
Yeah, I mean, what's your take on that, Simon? Have they? Are we going to see that wave tap out now? I mean, what's your? I mean, we're not really talking about.
No, I think it's likely to carry. I think it's likely to carry on. Actually, I think one of the other things about the UK is that the rules are very clear in the UK for takeovers. I mean, you have the Monopolies and Mergers Commission. The government has changed the rules a little bit for technology transfer and national security, but essentially, if you've got a standard business and we are open, the market's open to takeovers, whereas the rules in many other countries are more complicated. And if you couple that with low valuations, with a lot of money in private equity hands, and many of these funds raised money last year either from new issuance or from selling other businesses, so there's plenty of money around. I think the UK is likely to continue to be a place where companies look to take advantage of those opportunities, and either corporate buyers or private equity buyers. I would push back a little bit on Joachim's comments about interest rates and a problem for the corporate sector, because the corporate sector, at least the listed corporate sector, has quite modest levels of debt at the moment. It's refinance compared to where we were pre-financial crisis. The levels of debt are much more manageable, and of course, corporates have funding that goes back many years in most cases, so that the sticker shock of rates going up takes a long time to feed through. So for most of the big companies we look at, we're not too concerned about higher levels of interest rates. I think the government's got a lot of debt, and the impact overall on economies of how much debt is sustainable is a really good question. And I think you're probably right to say that rates can't go too high because from an economic point of view before it does start to impact activity. But I think corporates we look at, we're not so worried about the rising cost of debt in terms of their ability to finance themselves and carry on. I think you could see some profit warnings because of the refinancing risk, which in some cases, and it's very stock by stock, but if they happen to have a big refinancing coming up and their earnings might be under some pressure because of the macro situation, you could see the odd profit warning because of the cost of debt, which we haven't had for a generation really, because cost of debt's been going down in one direction. So I think that's something to watch for with highly leveraged businesses. But I'm more relaxed about the big companies and their ability to finance themselves at slightly higher interest rates.
Okay, perfect.
Which doesn't not to say that I think not to say I think rates are necessarily going to keep going up forever. I think there's good reasons why inflation might roll over and why rates might come down anyway. But I just don't think it's a massive issue for the big companies.
Okay, perfect. Well, ladies and gentlemen, we are coming now to the end of our moderated session, but it's going to be predictions time. So we're going to ask each of you to be put on the spot, and so let's start with Eloise. What's your main prediction, and what do you think is going to happen now for private investors? What should they be looking at and looking out for, as it were?
Yeah, I mean, coming from a research and innovation background, there's certainly many UK businesses that are fit for the future, whether that's around energy transition, cybersecurity, growth in the gaming or the online retail space, fintech, or life science. I mean, in the case of life sciences, we've seen a lot of powerful public-private corporations delivered in the UK, giving some really great success story. Just thinking about the DNA sequencing that was done by the Oxford Nanopore Technologies. But there's also many new sectors where the UK can excel. And so there's some opportunities that are not as visible as they could be, largely because of the current listing rules. But at the same time, there's also scope for some of the old economy businesses to reinvent themselves. For example, I'm thinking about Shell and BP, where we believe they can be part of the solution to address some of the greenhouse gas emissions. And another example is Drax, which is one of the UK's largest operating coal power stations, who have been doing an immense job at shifting towards renewables and have committed to being carbon negative by 2030. So if they do that, which is quite ambitious, they'll be one of the leaders in carbon capture storage, not only in the UK but potentially also globally. So for a lot of these reasons and the resilience that the UK market has shown for the last 18 months, we see many of the UK listed companies as having great potential, and we expect that it'll only be a matter of time before the wider market joins those private equities who's been snapping them up.
Okay, excellent. Thank you very much. So let's put the same question to Joachim. I'm sure you're going to be pouring cold water on the future. So what's your take on what's happening now?
Let me first lift you up a little bit and confirm that when it comes to the outlook for the next 3 to 5 years or even longer, I'm actually quite happy to invest in the UK, not just because valuations are very cheap across most sectors, and on a sector adjusted basis, it's definitely the cheapest market amongst the developed ones. But it is something where I think if you have a big sleeping pill and you take it now and wake up in 5 years' time, you will not regret having invested in UK equities. The problem comes in, and that's where the cold water bucket is standing right behind me, is the next 12 to 18 months. Now, we're already seeing clearly over the last couple of months, equity markets going down quite a bit as interest rates are rising and investors are increasingly worried about recession fears or runaway inflation or the combination of the both. And there, I think at the moment, investors have probably reached a point of maximum pessimism. And as that goes away and inflation tops out, we could see a bit of a rally going forward in the order of 10 to 15% is entirely possible. But in the end, especially with the Fed hiking so aggressively its interest rates, it is almost inevitable now that the US will go into recession towards 2023. And with China slowing down as well, we're basically in a boat where the macroeconomic environment is deteriorating rapidly. And that is something where equity markets won't be able to kind of avoid that drag. And so, at the risk of sounding incredibly stupid, I think equity markets from here on will go up and then they will go down. But that's not really a helpful prognosis, I guess.
But probably accurate, I would imagine. So Simon, let's just finish off with you. We've got another audience question that you might be able to work into your predictions. We've got Henry Nickel again. He says, given that many of the commodities and energies companies are in the FTSE 100, should investors now be looking more at the 250 and AIM? I guess that's related perhaps to a valuation rotation question. But I mean, if you had to bear that in mind, what would your predictions and expectations be?
Yeah, well, there's a very famous quote, which is, it's very difficult to make predictions, especially about the future. And I think firstly, trying to call where the economy is going to go, as Joachim said, is very, very difficult. There's lots of challenges, really hard to know. Secondly, trying to know what the market's going to do when the economy does that, even if you're right, is equally, probably even more difficult, because we very often find in the past we think the economy is going to do one thing. Even if it does that, the market does completely the opposite of what we think. So we tend not to think in those terms, and I think trying to predict where the stock market is going to go 6 months, 12 months, even 2 years is very difficult. I think it's absolutely right, as has been said, to focus on the long term. I think the valuations in the UK are interesting, but there's actually two big distortions in the market at the moment. The first is what you might call the value growth distortion. So the gap between valuations, there's always a higher quality growth businesses are always on a high premium, or a premium to everything else. That gap has got very, very wide in the last few years. It has come back a bit, but it's still well above average. So your investors are being paid, you have to pay a lot to buy high quality, high growth companies compared to average. And so I think there's still a lot of interesting areas outside of that, of companies that are undervalued. I think the other one that's become a bit more apparent this year is the gap between defensives and cyclical businesses. Because of all the economic uncertainty and inflation uncertainty, defensive businesses understandably have performed very well. Cyclical companies have come down quite a lot, and maybe it comes back to this. You could throw in resources as well. And to your question about the FTSE 100 being very resource heavy and very defensive heavy, that's been an area of strong performance. You could argue that those areas look less attractive. They've had a great run, and there may be scope in the more cyclical areas, and that's typically the FTSE 250, the more domestic companies. And we actually see better value starting to emerge in some of those smaller companies, some of those mid-cap areas, some of those more domestic and cyclical areas. So industries we like, for example, house building, construction, there's a lot of really strong businesses there. Some element of inflation linkage perhaps on the asset values, good value, really good attractive valuations on a long-term basis, even if they go through a short-term period of pain. The financial sector, not necessarily the big banks, but outside of the banks, there's a lot of financial companies in the UK, a lot of variety across many different industries and sub-industries, finding many opportunities there. And I think the other thing is just to say it comes down to stock picking. There's a lot of, there's some really interesting situations out there. The market is driven a lot by macro trends and passive trading and passive funds, and the individual company, the liquidity in individual companies is quite low, and you're seeing some pretty wild swings and big opportunities at the individual company level. So if you have the ability and patience and skills to look at individual companies, there are some really interesting opportunities rather than just the big sector calls. So I hope that answers the question.
That's perfect. Thank you very much. Well, I can see our tech people are signaling frantically to bring the session to a close. It's been a great pleasure to talk to all of you. Thank you very much for giving up your time today. It just leaves me to thank the viewers and our session sponsors, Allianz Merchant Trust. If any of you receive a feedback form, please remember to complete it after this event. You can also stay tuned for more Investors Chronicle events on our website. And our next session, in fact, will be this afternoon with my colleague Miriam McDougall, who will be asking whether investment trusts are the best way to capitalize on mega trends. So thank you all very much. And that brings our session to an end. Thank you.